Higher long-term yields are grinding higher again, just as the earnings cycle is delivering some of the strongest growth in years, and that tension is quietly reshaping equity risk across sectors. Welcome to vTalkInsight, Equity Pulse Daily for August 7th, 2026. Let us unpack how the macro backdrop, sector rotation, and company headlines are interacting beneath the calm headline indices. Equities are trading against a very different rates backdrop from even a few weeks ago, with long-dated treasuries repricing sharply on term premium rather than fresh policy moves. 10-year yields around 4.6% and 30-year yields near 5.2% reflect mounting concern about persistent inflation, large fiscal deficits, and uncertainty over where the Federal Reserve ultimately wants the policy rate to settle. On inflation, the message is mixed, and that is exactly why markets feel on edge. Recent data have been more benign, yet there is still skepticism that inflation will fall back to the Fed's 2% target over the next several quarters, especially with higher gasoline prices feeding through to consumers. At the same time, wage growth has cooled toward 3.5% and headline layoffs remain low, pointing to a labor market that is tight but not overheating and giving the Fed cover to stay data-dependent rather than pre-committing to a path. What has really changed is confidence in the Fed's communication. Years of missing the inflation target and recent missteps have left markets doubting the value of forward guidance, with rate hike odds for September dropping from near certainty before the last meeting to something closer to a coin toss today. Investors now care less about what the Fed predicts and more about how it explains each move, and the upcoming Jackson Hole speech is seen as a key moment for the chair to reset the policy framework. Crucially for equities, financial conditions are tightening even without another hike. Higher long end yields driven by term premium, heavier Treasury supply, and global deficit financing are lifting discount rates across the curve, while 2-year yields around 4.2% keep the front end restrictive. Inflation swap markets still signal faith in long-run Fed credibility, yet questions about a potential policy mistake and the risk of stagflation linger, especially if Middle East energy tensions reflare. Against that backdrop, with the VIX holding in the mid-teens, the key watch points for equity risk are upcoming inflation prints, the July jobs report, and the tone out of Jackson Hole, because any surprise there directly feeds into how markets price duration-sensitive assets. Set against that rates backdrop, the earnings picture looks exceptionally strong. S&P 500 second quarter earnings are running around 50% year-on-year, or more than 30% even excluding investment gains at Google and Amazon, with revenues up about 14% and all 11 sectors delivering sales growth. Margins are expanding in most sectors, and for the first time in 2 decades, analysts are revising earnings estimates up during the quarter instead of cutting them. Valuations have quietly adjusted as this earnings power has come through. Forward price-to-earnings ratios for the S&P 500 have slipped below 20 times, with multiples compressing by roughly 2.5 to 3 points this year, and tech sector valuations now sitting below their own historical averages. On the surface, that makes the market look more reasonable, but under the hood current prices still embed more than 20% annual earnings growth for 5 years, a level rarely seen outside early cycle recoveries and hard to square with a 6 to 7% nominal growth world. That tension is what has some investors describing classic bubble dynamics. There is widespread use of margin, options, and leveraged exchange-traded funds by both retail and wealth clients, and hedge fund leverage relative to GDP is reported at unprecedented levels, yet there is no single obvious fault line. Current enthusiasm for artificial intelligence and semiconductor plays, combined with multi-year index gains and what many call greed sentiment, leave room for powerful upside if earnings keep surprising and cash on the sidelines is forced back in, but they also mean that any shock to growth or yields could trigger a disorderly de-risking rather than a gentle rotation. The most intense expression of that duration risk sits in the AI and mega-cap tech complex. Alphabet has just raised $25 billion in bonds, part of roughly $80 billion of new debt and $85 billion of equity financing since October to fund gigawatt-scale cloud and AI infrastructure, pushing free cash flow negative and putting buybacks on hold. Yet Google Cloud's backlog and booked revenue are both growing more than 80% year on year, so the company argues that the returns on this spend are already coming through. More broadly, AI is beginning to show up in operating performance across sectors. Enterprise demand for AI agents is projected to build toward a $1 trillion market by 2030, with examples like AI-powered drive-thrus lifting per-location restaurant sales and companies that embed AI into workflows seeing widening profitability gaps versus peers. At the same time, only about a fifth of companies have implemented AI at all, suggesting a long runway for adoption even if current pricing and venture valuations in parts of the ecosystem prove too optimistic. The semiconductor space captures the other side of the story, where AI demand is real but market positioning is fragile. SanDisk and Western Digital both issued revenue guidance below lofty expectations, triggering sharp share price declines and sparking a broader sell-off in memory names, with stocks such as Samsung and SK Hynix under heavy pressure and Korean indices hit by forced deleveraging. Yet memory producers are still seeing strong AI-driven demand, limited new supply, and low price-to-earnings multiples, and the Philadelphia Semiconductor Index has just logged its biggest four-day gain since early 2020, underscoring how quickly sentiment can whipsaw. Investors are responding by making the AI trade more selective and more bottom-up. Some semiconductor and optical names are priced as if today's capex boom will run for many years, while others tied to memory or diversified compute look comparatively underowned. And AI revenue at Microsoft is heavily concentrated in its partnership with OpenAI, adding a layer of single counterparty risk. With AI capex extending equity duration and major platforms tapping bond markets hard, the link between 10-year yields and tech valuations is tightened, so stability in the long end is now a prerequisite for another sustained tech-led leg higher. One encouraging development for overall market health is that earnings strength is no longer confined to a handful of tech names. Industrials are benefiting from onshoring and infrastructure trends, with sector earnings growth running well ahead of expectations. Siemens has upgraded earnings per share guidance on the back of double-digit growth in both automation orders and software revenue, and it is leaning into digital twin technology to serve AI data center and efficient factory demand, even though its shares sold off as investors questioned whether its digital businesses can keep up with very high expectations. The insurance sector is another quiet winner from the global capex cycle. Swiss Re's first-half results were driven by strong core underwriting, while Zurich Insurance reports growing demand for specialized cover on large, complex infrastructure and data center projects. At the same time, rising climate-related losses and widening wildfire protection gaps, especially in Europe, are pushing up premiums and spurring innovation in catastrophe bonds and alternative capital, which supports earnings today but also embeds more climate risk into long-term balance sheets. Consumer and services names illustrate how uneven the macro environment feels on the ground. On one side, companies like Airbnb and Lyft are beating expectations and raising guidance. Atlassian and Twilio have surprised to the upside in software, and Yellow Beauty has lifted its growth outlook after delivering more than 30% net sales growth. On the other, a major foodborne illness outbreak has knocked stocks such as Kava and Yum brands sharply lower, with foot traffic down as much as 30%, and fast casual and quick service restaurants are seeing year-on-year visitation declines as consumers react to higher menu prices and shift spend toward value-oriented grocers and warehouse clubs. Meanwhile, GoodRx and Alino Health highlight resilient demand for healthcare value and pet wellness, underscoring that consumers are selectively trading down in some categories while treating others as non-negotiable. Beneath the index-level calm, a web of leverage and structural flows continues to shape how shocks propagate through equities. Leveraged exchange-traded funds represent less than 2% of ETF assets, but can reach around a fifth of daily trading volume, amplifying late-day swings, and hedge fund leverage relative to GDP is described as unprecedented, with recent volatility in Korean equities and flash crashes tied more to mechanical unwinds than to any abrupt change in fundamentals. The SpaceX lockup expiry is a vivid example of how supply events can interact with that leverage. Roughly 900 million insider shares have just become tradable, more than doubling the float to over 1.5 billion shares, with further unlocks scheduled that could triple the float by year-end. The stock initially dropped, then rebounded despite high short interest, and the multi-stage lockup structure is being watched as a potential template for future mega IPOs, with implications for how private valuations and public market liquidity reconcile in high-profile tech names. Operational and regulatory risks round out the picture. A wave of advanced voice phishing attacks targeting firms such as Millennium, Two Sigma, and Citadel highlights how AI-enabled cybercrime is scaling from dozens to potentially thousands of targets, creating both headwinds and tailwinds for cybersecurity providers like Palo Alto Networks, which is also navigating a new security review in China. In Europe, bank consolidation continues as UniCredit moves toward majority control of Commerzbank, and Intesa is expected to prevail in merging with BPM, signaling a gradual strengthening of bank balance sheets even as integration and strategy risks remain. Together, these stories remind equity investors that with volatility low and indices near highs, idiosyncratic shocks from leverage, supply, or cyber events can still travel quickly through the system. Stepping back, the equity story right now is a tug-of-war between powerful earnings momentum and a steadily more demanding macro and policy regime. S&P 500 profits are beating by a wide margin, breadth has improved beyond mega-cap tech, and sectors from industrials to insurers and selected consumer names are benefiting from AI, infrastructure, and resilient pockets of demand. At the same time, higher long-term yields driven by term premium, large fiscal needs, and heavy AI capex are tightening financial conditions, while ambitious multi-year growth assumptions and elevated leverage leave little room for error. The balance of risk shifts with every inflation print, labor report, and signal from the Fed, and within equities market leadership is likely to hinge on how rate-sensitive AI beneficiaries, semiconductors, and other long-duration assets trade against more cash-generative, shorter-duration sectors. Watch the long end of the Treasury curve, the tone out of Jackson Hole, and how upcoming earnings guide for capex and margins, because those will be the key catalysts for any change in equity market direction, breadth, and volatility. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.